Hello, good day. Jacob here. Today we're looking at Baxter International in the healthcare equipment and supplies industry. 17 billion market cap on 25 billion enterprise value. Current PE looks cheap, but let's dig into the numbers here. So 10.7 billion in revenue to 14.8. That is about a 2% a year in growth. So not a whole lot of growth there, 2 to 3% maybe, but relatively consistent. And gross margin down a bit, operating margin down a bit. Not what you want to see with a slow growth company. You definitely want to see those margins expanding so that they're becoming more efficient with less dollars. And then return on invested capital, most recent year pretty solid, 11%, maybe averaging high single digits. So actually not so poor there. And the balance sheet shows 3.1 billion cash on hand, but 11 billion long-term debt, 2.6 billion short-term debt. So it's good to see they have enough cash to write off that short-term debt, but that $11 billion is quite a lot. Let's see what it is in relation to cash flow. So last 5 years, a little over $1 billion. So you're looking at about 10 years of their 5-year average free cash flow. That's a lot. That again means that if they produce what they have the last 5 years, it will take them 10 years to pay down that debt. Debt is likely due before the 10 years is up. So they're going to have to refinance to somebody who's able to refinance to them and willing to. And, it just gets a little bit concerning. I also don't like that free cash flow was higher 10 years ago than today, and capital expenditures are down. That could mean they're being more efficient, but likely that just means they sold off some things and less growth. But I mean, debt reduction the last 2 years after this huge acquisition. Immediately after 2 years, it doesn't look like this acquisition was a good idea based on free cash flow. It doesn't look like it gained much in free cash flow, and it cost them $10 billion, and they went $9 billion into debt to afford it. So to me, immediately, just based on the 2 years of numbers I'm saying here, which is not a lot, but it doesn't look like that was a very positive acquisition. I want stuff that's hitting the bottom line, not just the top line. Top line, whoop-de-doo, I don't really care. They could gain 1% a year for 20 years. I don't care. But if you're becoming more efficient and gaining 3 to 5% on your earnings side and then buying back 3 to 5% of shares, that's how you're really going to get the return you're looking for with buying companies that have little growth out of them. And so I don't think their use of free cash flow is really that impressive to me. I mean, they're paying a dividend that pays out $587 million. That's about 50 to 60% of their 5-year average free cash flow. And like I said, they have over 10 times their 5-year average free cash flow in debt. So, I mean, with that dividend, even if you don't increase it at all, you're really leaving maybe 10% to share repurchases, reinvestment, acquisitions, and then leaving 40% to debt reduction, which I think is an absolute necessity with the amount of debt they have. So I'm going to be pretty conservative here, and it's probably not going to look pretty. But on the revenue side, let's say 2%, and then let's do 11. Pretty low. Again, this is partly due to low growth at the end of 7 years, and also the enterprise value quite a bit higher than their market cap. And so their margins, let's do, at least those are fairly consistent. I'm good with 10. Share change, they haven't bought back any shares. Stock-based compensation, 133. So, I mean, roughly 1%. Let's be a little bit relaxed and give them 0.5%. Dividend, again, I don't want to increase it because they're already paying 50 to 60% of their 5-year average there. So even if they increase the earnings, I want this to stay the same. So at the end of the 7 years, it's still probably going to be 45, 50% payout, but at least then, it leaves a little bit more, because cutting a dividend is great and all if, no one cared about it, but everyone loves their dividends. And so if you cut the dividend in half, it's going to leave a lot of investors wary to go into your company, which, I mean, 3.5% is a huge yield. You're looking at almost 3 times the market average, well over double. And so I think that's what they have going for them. I don't see them cutting it, but I definitely don't want them to increase it because of already how large that payout is. And I want them to focus on debt reduction for a company that's this stable. I want them to focusing on deleveraging themselves and then growing through paying a dividend and then share repurchases advantageously. So I do hope you enjoy the video. saying it needs to fall 45% to get to the price we're looking for. But anyways, I hope you have a great rest of your day. Thank you.